service provider to, the physical asset movers, logistics service companies. You guys, OTR, same kind of story. You're a service provider to the industry. I don't think I'm going to surprise you by saying it's been, a tough year.
Yep.
I guess tell me a little bit about what you guys are seeing from factoring the working cap, providing the working capital that keeps the industry afloat.
Sure. I think we're seeing a lot of the same that we have over the course of the last couple of years, which by and large is unique, mostly because of the longevity that we've been seeing kind of these market headwinds.
Yeah.
Prior to COVID and the boom, period of 2-ish years.
It was the golden era.
Yeah, exactly. Before that, it was predictable. It was still a very cyclical industry. We knew that generally, we've always been very growth oriented, that we would have to leverage kind of up-market scenarios to really bolt on a bunch of growth. And in those kind of softer periods, I think a lot of us in the industry took the perspective of continuing to invest in those growth measures because we knew that it was going to be a relative.
And every one of these downturns we've seen,
6 months, 9 months, 12 months max, where you're kind of, investing, I would call it, in what you anticipate to be growth in the future. So the longevity that this kind of bear market or freight recession has been really unique. So we've, I think when you're in the type of market that we were in previously, where you can afford to do that, it is important that you're able to capitalize on the upswings because those opportunities, when the market is working for you, only come every once in a while. And I think that the growth-oriented businesses were able to do that very well and very predictably. I think a lot of businesses tried to do that as the market started to turn for a year and a half. And over the last 6 months to a year, I think people are taking a good hard look to make sure that their businesses are sustainable, that they've got costs under control, that they're acquiring business that is accretive to their bottom line. So it's a little different approach, but I think people are starting to, and I think even the conversations that we've heard over the course of the last couple of days, freight brokers, factoring companies, freight brokers specifically, are gearing up for that next leg of growth, right?
Yeah.
They're anticipating.
We've heard a lot of people that are starting to invest, maybe seeing shoots.
Yeah, because you don't want to miss the opportunity.
Right.
The market is by and large under control for market participants. And so you have to be available and have the ability to capitalize when that market turns in your favor, because for us, it's very much everything's working against us or everything's working for us, right? In bear markets, there are more carriers going out of business, which for a factoring side of the business is not a good thing. It's less opportunities.
Yeah.
There are less carriers getting their authority. Freight rates are generally trending down. All of those things working against us. The opposite is true in a bull market when you're bolting on new business, right? There are new authorities. There's carrier, retention. Attrition goes down, and freight rates are increasing. And so being able to capitalize and with market swings is still very, very important. I think what a lot of people are excited, when. I know that's a topic of conversation. I'm not going to make any proclamations up here.
Left my crystal ball up.
Yeah, exactly. It's I think the longevity is the most unique part of what we've seen over the last couple of years. Hoping it shifts here soon.
Yeah. So one thing that we typically hear from factoring companies is when times get a little lean, people maybe their fraud picks up a little bit.
I think
people take advantage.
Jordan coming on right before is a good opportunity to discuss that. Obviously, they're opportunistic. There are people that come in with the mindset to defraud, right? Where they're coming in specifically creating their businesses to try and defraud us or the industry as a whole. There are also people that are running good businesses or running real businesses until things start to get too tight for them to make ends meet.
Yeah.
Then they're looking for opportunities just to survive.
And what does that look like? Does it look like factor twice? Or does it look like changing the invoice amount?
Yeah, it looks like it much. We have seen it all. Yeah, on an industry that relies so much on physical documentation, so many layers of communication when you think about supply chain and the fact that from the load being delivered to that paperwork in many cases ending up at the shipper, the receiver, whoever is responsible for paying that freight bill. It's an elongated process, right? That requires a lot of communication via email, a lot of communication via phone to ensure that it delivered, to ensure that you've got the right documentation. And so anytime you have an extended game of telephone being played, you're going to have opportunities for people to come in and
Those are the cracks into which
but yeah, I mean, billing for invoices twice, using fraudulent PODs, people coming in with, Jordan talked about, basic vacancy numbers. We do a lot of underwriting on the front end for, especially our factory business, trying to sort that stuff out to identify, have you seen these people in other areas of the portfolio? Have they come in and tried to get factoring services in the past? So we're leveraging a lot of that information to make informed decisions. Even if we haven't worked with someone in the past, if we know that it's an alias or they're associated with someone that we've identified as, a bad actor, obviously we're cutting those people out in the front end so that they don't have an opportunity to defraud us.
Yeah, that's good. The interest rates have obviously been a tough challenge for carriers. And then you guys are in more or less the banking business.
Yeah.
Does that affect them from a factoring rate, or is it more from their payment on equipment is really high, and that's a pressure of the credit?
Yeah, I mean, from a factoring perspective, factoring rates have not gone up over the course of the last 2 or 3 years.
Well, and if you control the fraud, that's one less thing you have to price into their rate.
Yeah, it's an interesting phenomenon just because obviously, the Fed, I think an hour ago or so, we were talking about Fed funds rates have gone bananas for the first, or prior to 3 years ago, it was near zero interest rates. What's interesting, and I think kind of what we might expect to see as the industry continues to press forward, is that a lot of the interest rate costs, and this goes for factoring companies, for freight brokers in particular, are being absorbed into the efficiencies that those businesses are creating.
Yeah.
Right. So when you think about gross margin and how that flows down to the bottom line, interest rates for a factoring company are obviously a huge component. They're also a huge component for freight brokers. They're floating funds for 30, 45 days, just like factoring companies in many cases, because of how shippers are paying. So as interest rates start to increase, their debt service becomes more of a concern. And I think you've seen that combined with all the other market factors where freight rates have come down, freight volumes are not moving with capacity.
A lot of pressure on the carrier.
Exactly. Well, and the broker, yeah. But the fact that you haven't seen top-line margin expansion in factoring or freight brokerage, generally speaking, means that the players are making less bottom line, or they're finding ways to supplement those costs with efficiency gains. Right. And so that's where you have to start getting creative. And I think that's where, especially in the last, I mentioned, year and a half, everybody had been running a very similar playbook prior to this extended freight recession, which was cut down, no brakes,
Take as much
easy gas, because you want to be available when the market turns.
Yep.
I think people have started to have to take a really close look, which is going to drive a lot of efficiency into those organizations. And then the ones that are still able to mobilize and turn on those growth levers when the market does turn, that's where you'll see some kind of bottom line margin expansion. But I don't necessarily expect the show, I don't expect broker top line margin or factoring top line margin, to be honest, to change much.
Yeah, a growth period can be risky for the brokers who are getting paid on fix and paid for.
Yeah, absolutely.
Yeah.
So it'll be an interesting dynamic to see. I think you have a lot of brokers right now making a lot of changes and taking a very close look. We have a lot of conversations in the space. They're taking a very close look at their operations to see how they get as lean as possible and lower their costs as much as we can. That involves, human resources, nearshore, leveraging technologies. AI is a huge buzzword. Jordan runs a technology company and doesn't use it, so take that for what it's worth.
The most honest technology practitioner here.
Yeah. So, but there are ways to cut costs out of your operations. It's been a big focus, especially over the last year.
Does that make you? The experience of the last 5 years. How do you think about how there be logistics service providers or folks like us who are selling into that market? What's the thing you think about your cost structure through the next boom and bust cycle, whenever it comes? May it be this fall.
I think obviously it needs to be, you have kind of a right sizing happening now in preparation for what is hopefully, obviously, to to kind of stem the tide of these market headwinds that we're currently in. But it'll be a huge competitive advantage as you go to the next kind of cycle. Obviously, those that are equipped to be able to lower their internal costs are going to be able to be more aggressive from a growth perspective. Right. Generally, you have efficiencies flowing into an operation, whether it be, deploying technology that does that, or any other being. Those growth-oriented businesses are then going to go out and try and put more business with those initial guns in a lot of cases. So that comes, paying trucks more if they have to, or charging customers less if they have to, in order to continue to grow their business. So I think you'll see a lot of people. I mean, it's historically an industry where people have reinvested into the business because there's so much opportunity if you're willing to do that.
Yep.
I think that will continue to be the case. I think we'll probably see something that is more normalized than what the last 4 years has looked like, if I had to guess. I think we'll continue to see some level of consolidation. We just saw Transix with the wire today, or whatever that news dropped, which is interesting. I think we'll see consolidation of attrition. In some cases, where you have people leaving the marketplace, that business just gets gobbled up by the rest of the players in the industry, or you have consolidation in the form of kind of traditional consolidation. You have people being purchased. So it'll be an interesting next few years, but I do expect it to be, at least from a longevity perspective, the cycles to be a little more manageable, right? Because it's very hard when you're in an environment where you never really know when it's going to end. It's very tough to plan for how you want to invest in business going forward.
For sure. So it sounds like you're saying that the best practice is don't be afraid to burn a little cash and invest. In advance of the upswing, but that's of course going to be tempered.
Yeah, I think traditionally that's work because 6 or 9 months you can weather. If you're burning cash for 2 years, not longer than that, it becomes a little less sustainable. I think a lot of us are anticipating we are somewhat close. I think investing in things that are going to make you more efficient for the long run, it's not a bad idea if you have.
Pay attention to ROI.
Yeah, it's not a bad idea if you have the opportunity to do so. I think that's where a lot of people have turned their eye in the industry over the course of the last year, like I think, which is great. I think investing in sales resources, investing in go-to-market, those types of things are somewhat contingent on how the market is going to pay off those investments. In a relatively short amount of time. Investing from an infrastructure perspective to make sure you can capitalize on those growth opportunities is a slightly different way to invest, but I think worthwhile ones.
Yeah. Of course, you mentioned, I was on stage earlier talking about AI. You mentioned it, is there
kind of that technology guy, a little something.
Exactly. But is there any of that going into kind of the decision-making, the underwriting, or factoring, or is it still pretty, you're focused more on automation and efficiency than this science project that might not work?
Yeah, I think there's selective ways that AI can be helpful. I think in our industry, it can be tough because a lot of what that AI is doing is dependent upon the data that you are feeding it.
Exactly.
A lot of the
very trained data
with AI and those products, and you've seen it even as Microsoft and Google have released their ChatGPT, or I guess Microsoft ChatGPT, but as they're competing, you can see that there's still kinks to work out, right? There's been a lot of news around the things that are being returned and the new chatbots. And so when you think about our industry, and like I said, how much communication is had in unstructured ways, how much data is passed in unstructured forms, the data integrity of what is fed into those engines isn't as reliable, which makes the output that those models are giving you even less reliable. And so that's the concern. I think if you have a high degree of confidence in the data you are feeding it, it allows you to make more informed decisions, and you can really leverage the power of that AI. I think in a lot of cases, we're trying to feed it on best guess and expecting it to be able to solve those problems for us, which in a lot of cases just take bad data in, bad data out. And you end up making worse decisions than you would have if you would have just taken kind of a more systematic or manual approach.
For sure.
I think there are certainly short-term ways you can pick up wins and efficiency without deploying AI. I think as that technology matures, it'll start to become more of a factor and can actually leverage for benefit. But we'll kind of see it when it's.
I would agree. I would say that, pay attention. Make sure you are paying attention. now is not the time to go.
Yeah.
Now's not to go. I wouldn't put all your R&D dollars there. Just
Yeah, it's not going to solve all of your issues.
so
Yeah, make some let's say an AI solution.
yeah, very good. So we've talked a lot about long-term trends here today, future supply chain, so about the future. I think I would say that the growth of the small carrier, the brokerages that supported an increase in the market share that belongs to small carriers. That's been good for the factoring industry for sure.
Yeah.
What do you see that trend continuing? How far is it going to go? What other long-term trends are you guys in the world of trucking working capital thinking about and paying attention?
Yeah, I think certainly fragmentation will still continue to be
Would increase?
long term. I think we'll probably continue on the trend that we have been over the last several years. Not the short term, but an extended horizon of a decade or a decade plus.
Yeah.
Actually, we're seeing a significant reversion to the mean.
Sure.
Both carrier markets.
When rates are $4 a mile, everybody's a business leader, right? It's when they're not, everybody.
Yeah.
Oh, we're going to rush back to lease on.
And we see that just like everything, and like I mentioned earlier, you're going to see more people jumping into the industry in a market that is improving, that is growing, that rates are increasing in. And so we'd expect to see those short-term trends to remain or continue to exist. I just think they'll be short, right? It'll go back to kind of the 6, 9, 12-month type of trends because you don't have these, in some call it once in a lifetime, but extraordinarily rare events like COVID.
Certainly, we feel to remember the story of I got into trucking and made a ton of money the first 2 years,
and I got crushed for the next 2 years.
Yeah.
So I think the overall trend will continue. I think certainly there's still opportunity, especially as the market begins to rebound.
Yeah.
Freight brokerage, like I said, is an interesting one. I think there has been a lot of fragmenting in that industry as well. And you're starting to see consolidation.
Yep.
The market will do what the market does, which is find a point where it is able to at least remain somewhat stable. And you're going to press up both ends and it'll adjust back and forth. But our market does a pretty good job of figuring out how to get to a point of equilibrium, despite the fact that it takes a lot longer in some cases than they would like.
Yeah. All right. Well, I think we've asked everybody, but short term, which quarter are we going to see brokerages and carriers stop having to hold their breath and maybe get a nice sustainable increase in rates where they feel comfortable with it?
We're kind of already seeing signs, and we're looking really hard. So.
That's what everybody says. Maybe that's not bleeding.
We are looking really hard, but we are starting to see.
What are those signs? What is that?
For us, it's freight rates over similar lanes, and so we're looking really closely at how our carrier business is doing. We're actually talking to our broker partners, right, both on the carrier factoring side as well as kind of on the Epay side, to see what they're seeing, what their customer sentiment is, whether it's honestly a lot of anecdotal feedback. How hard is it to book trucks? Is it harder today than it was a week ago, 2 weeks ago, a month ago, 6 months ago? Because that eventually turns into something that manifests itself in pricing. Sure, that trucks become more difficult. And so we're starting to get that.
Tender rejection.
Yeah,
We're talking about the same problem. We look at two different angles.
Exactly. And so, I think all of that has an impact of when we think we'll see a sustainable uptick. I would say Q4 is our best case. But I don't think they're going to go. I don't think it's going to be a 30 or 40% jump in Q4.
No.
I just think something that begins to put them in a position where they're not completely underwater.
Right.
Especially on the carrier side, operating costs by and large, especially for those got in the industry in 2020 and well on 2022, are so high as they're still operating on that equipment that they purchased, right, that it's going to be very difficult for them to get to a point where they're profitable on every single load. So I think we'll start to see and hopefully gradually climb north over the course of the next 6 to 9.
You heard it here from your lips to God's ears. Fourth quarter, says Clayton. Thank you for making the drive down from North Atlanta, and always great to see you.
You too. Thanks.